The Reserve Bank of Australia yesterday decided to keep cash rate on hold at 3.6%. For millions of Australians with mortgages, this means no immediate relief, but also no surprises. Let's break down what happened, why it matters, what it means for your wallet. The Reserve Bank Governor Michelle Bullock announced that the cash rate will remain at 3.6%. This might sound disappointing, but here's the important context. Interest rates have already been cut 3 times this year, in February, May, and July. Those cuts are already saving mortgages holder real money. For someone with a 700,000 mortgage, those 3 cuts means they're saving about 330 per month or roughly 4,000 per year. That's real relief. That's already flowing through the households. The questions everyone asking is, why no cut yesterday? The answer comes down to a recent inflation data showing prices are rising slightly faster than expected, particularly in services and housing costs. The Reserve Bank wants to see more evidence that inflation is staying under control before cutting again. Think of inflation as the speed which prices are rising. The Reserve Bank's target is to keep inflation between 2% and 3% per year, what they call low and stable. Here's where we stand. Inflation has come down dramatically from its peak and is now back within that target range. Both headlines and underlying inflation are at their lowest levels in almost 4 years. That's genuinely good news. However, and this is the critical point, recent monthly data showed some component of inflation ticking higher than expected. Services inflation, which includes things like haircuts, restaurant meals, repairs, has been stickier than hope. Housing-related costs are also elevated. Governor Bullock stressed an important distinction that many Australians misunderstand. When the Reserve Bank talks about lowering inflation, they don't mean price will go back down to pre-pandemic levels. They means prices will stop rising so quickly. The higher prices level we're experiencing now is permanent. What we're controlling is how fast prices continue to increase from here. The interest rate decision has ignited fierce political debate about who's responsible for keeping rates elevated. Treasurer Jim Chalmers defended the government's economic management, pointing to 3 cut rates already delivered this year, falling inflation, low unemployment, and improved budget position. He emphasized that Australia has navigated global uncertainty relatively well, where the economy is still growing and unemployment remains low at around 4.2%. Shadow Treasurer Ted O'Brien painted a starkly different picture. He blamed government spending for keep rates higher for longer, noting that mortgage holders are paying $1,800 more per month compared to when the coalition was in the government. He argued that excessive government spending, $160 billion more this financial year than under the previous government, is fueling inflation and limiting the Reserve Bank's ability to cut rates further. This represents the fundamental economic debate. Does government spending support the economy during challenging times? Or does it add inflationary pressure that forces rate to stay higher? The answer likely lies somewhere in between, but both sides are framing the issue to maximum political advantage. Looking ahead, the Reserve Bank will make its next decision in November. By then, they'll have more labor market data, September quarter inflation figures, and updated economic forecasts. Market economists are now predicting perhaps only one more rate cut this year. If that, some are questioning whether we'll see further cuts at all, given the recent inflation reading and signs that consumer spending is picking up. Governor Bullock emphasized that the bank remained data dependent, meaning each decision will be based on incoming economic information rather than a predetermined plan. The risks are broadly balanced, meaning things could go either way. On one hand, if consumers start spending more conveniently, are their real incomes rise and wealth increases through higher houses and share prices. The economy might not need further stimulus. That would be good news. It would mean the economy is recovering on its own. On the other hand, if global uncertainty intensify or the labor market weaken unexpectedly, further rate cuts could be necessary to support employment and economic growth. One issue that come up repeatedly today is housing affordability. Governor Bullock acknowledged the difficulty young Australians face entering the property market, noting that as an interest rate falls, house prices tend to rise, making it no easier for first home buyers. She identified the core problem as a structural deficit of supply. Simply put, we're not building enough homes to meet the demands. While governments are working on this, she admitted she's not confident it will make any impact in the next 2 years. This frank assessment highlights why housing remains one of Australia's most persistent economic challenges. So, where does this leave everyday Australians? If you have a mortgage, you're already benefiting from 3 rate cuts this year, saving thousands of dollars annually. But further relief may be limited or delayed as the Reserve Bank watches inflation carefully. The broader message is that Australia's economy is in a delicate transition. Inflation has come down significantly, unemployment remains low, but worse, not quite as the point where the Reserve Bank feels comfortable easing further. The next few months of economic data will be crucial in determining whether more rate cuts are coming or whether we reach the end of this easing cycle. This is Miko Santos, and welcome to Inside OSPO.